Did you know that the average investor underperforms all asset classes and can barely beat inflation? Yeah, that's right. Individual investors are terrible at investing on average. And one of the reasons is that many don't truly understand their investment approach.
So today, we're going to talk about the 6 types of investors and help you identify which one you are. Not only will this save you years of trial and error, but it can also save you from a lot of costly mistakes. So are you ready to know your investor personality? Let's find out.
Hey there, I'm Stephanie, tech veteran, engineer, and creator.
And I'm Bertrand, founder of App Economy Insights.
In his book, The Money Game, the late George Goodman, better known as Adam Smith, explains, if you don't know who you are, the stock market is an expensive place to find out.
Investing can be daunting, especially when everyone seems to have an opinion. But the truth is, one investor's trash can be another investor's treasure. So let's tune out the noise and focus on what matters most, understanding what kind of investor you are.
Adam Smith described investing as the greatest game of all. And like any game, to win, you need to understand the rules, the goal, and most importantly, your game plan. And that's what we're diving into today.
Maybe you caught yourself switching your investment approach based on the latest trend or the macro environment. Howard Marks has a perfect analogy for this. He says, if you wait at a bus stop long enough, you're guaranteed to catch a bus. But if you run from one bus stop to another bus stop, you may never catch a bus. The type of investor you are will likely guide you toward companies in different phases of their life cycle. Why? Because they give you a different opportunity in terms of risk and reward.
To better grasp this concept, let's look at companies at different stages of their life cycle. Each phase offers unique opportunities in terms of risk and reward.
So here is a simplified breakdown. In this chart, I borrow from a great visual from Brian Feroldi. First, the startup phase. Many companies at this stage are private, sometimes with no revenue yet, let alone profits. A perfect example is OpenAI. These can be hit or miss, with many companies failing to reach expectations. 90% of startups fail, according to data from Failery.
Next, we have the hypergrowth phase. Companies here reinvest aggressively in the business, focus on growth, and are often still unprofitable. A great example is Snowflake. The value of the company depends on its long-term earnings power and the durability of its growth. Snowflake IPO'd in 2020. The revenue is growing fast, even in a challenging macro environment, but the profit margins are still deep in the red. In this phase, the range of outcomes is wide, with large upside potential, but also a significant downside if the company fails to deliver on high expectations.
Next, we have self-funding. Companies like Uber today, just breaking even. We can't base any valuation on existing earnings. There's none. Management is usually still reinvesting in future growth and fine-tuning its business model. Some investors may see a broken business. Others will focus on the unit economics and long-term potential.
Next, we have operating leverage. Amazon has been in this phase for many years. Another great example is Salesforce, which is expanding its margins through scalability and efficiency. In this stage, revenue grows faster than operating expenses. And so as a result, earnings can grow faster than revenue. These companies can appear overvalued at first sight without extrapolating their earnings growth potential, and it can lead to missing great investment opportunities.
Okay, the 5th phase is maturity. These are the stalwarts, like Visa, Coca-Cola, or Bank of America. You can find many of them in Warren Buffett's portfolio. They have a steady business with normalized, predictable growth. As a result, it's easier to evaluate them based on the price to earnings ratio and estimate their future cash flows.
All right, number 6, decline. When revenue and earnings decline, companies can look artificially cheap. Why? Because earnings are likely to contract in the future, making an evaluation based on trailing metrics look flattering. All bets are off once a business turns unprofitable with no clear path for a turnaround. Valuation metrics based on trailing earnings become useless. The only hope is for a turnaround or for the company to sell its existing assets to a willful buyer. A great recent example, Bed Bath & Beyond.
Now, before we review the 6 types of investors, we have a small request. We'd love for you to hit that subscribe button. You'll get instant access to our weekly videos as they are released and help others discover our channel, so we can keep creating content that helps you become a better tech leader, investor, and entrepreneur. Now, let's talk about the different types of investors. A common saying is beauty is in the eye of the beholder. Beauty can be judged objectively because what one person finds beautiful may not appeal to another. Value, like beauty, is subjective. Investors' valuation perspective depend on their goals, timeline, and personal circumstances. Let's explore these mindsets, shedding light on your investment philosophy and market dynamics.
All right, first we have value investors, the Warren Buffetts of the world. They focus on companies with stable cash flows and try to get assets below their intrinsic value. They use valuation techniques such as discounted cash flow, DCF, analysis, price to earnings, PE ratios, and price to book, PB ratios. And their main aim is to acquire assets below their intrinsic value and hold them for long-term appreciation or steady return.
All right, next we have growth investors, like Cathie Wood from ARK Invest. They bet on companies that have significant growth potential, even if they seem overvalued today. Wood famously invested early on in Tesla. Their toolkit might include price to sales, PS ratios, price to gross profits, or discounted growth models. They aim to pinpoint companies in their hyper-growth phase that promise substantial returns over time. They focus on where the business might be several years in the future.
Next, we have event-driven investors. Activist investor Carl Icahns is a great example. They base their investment decisions on specific events or catalysts that can drive substantial changes in an asset's value. Techniques such as event arbitrage, options strategies, or specialized valuation models help them analyze the potential impact of events like mergers and acquisitions, spin-offs, or regulatory changes on the asset's valuation.
Next, we have momentum traders. They are trendspotters. The late William O'Neill, founder of Investors Business Daily, was a famous momentum trader. Their investment decisions rely on market momentum, trends, and investor behavior. Using technical analysis, including price patterns and volume trends, they seek to profit from short-term price movements.
Next, we have venture capitalists like Marc Andreessen of A16Z. They focus on early-stage high-growth companies, especially in the technology sector. Their assessment hinges on disruptive technology potential, market size, competitive advantage, and management team quality. Given the high uncertainty and limited financial data, they use valuation methods like the risk-adjusted net present value or the market approach. Their performance follows the power law, with a small number of their investments driving most of their returns.
Finally, we have contrarian investors. Famously portrayed by Christian Bale in The Big Short, Michael Burry is the ultimate contrarian investor. These investors go against the grain, looking for undervalued or overlooked assets by the market. They don't mind investing in companies that are declining. They seek opportunities in industries or companies that are currently out of favor or facing temporary challenges. Or they short popular investments and bet they will fall. Techniques such as asset-based valuation or deep value metrics help them find potential upside.
All right, so remember, these styles are not mutually exclusive. Many successful investors employ a combination of these approaches, tailoring them to their investment objectives, risk tolerance, and prevailing market conditions.
Yeah, for example, my investment strategy is a mix of value, growth, and VC investing. I've got mature companies like Apple, hyper-growth ones like Snowflake, and even some young startups from my network here in San Francisco. What about you, Steph?
Yeah, I'm also a mix of the same, value, growth, and VC. I angel invest, and I also invest in hyper-growth and mature companies too. And not to mention my beloved dollar cost average approach to investing in mutual funds. I don't know, does that make me boring or lazy?
Not at all. Nothing boring or lazy about that, Steph. Dollar cost averaging is a proven strategy. In investing, often the simplest approaches yield the best results. I do the same thing and invest in low-cost ETFs every month. Understanding your investor personality will not only help you make more informed investment decisions, but also navigate market trends more effectively.
Okay, now it's your turn. So have you identified your investor type yet? Let's keep the conversation going. Drop a comment below telling us what type of investor you are. And if you found this video helpful, show us some love by hitting that like button, subscribing to our channel, and sharing this video with your friends. I mean, the more the merrier, right? Are you ready to level up your investing game even further? Then you definitely don't want to miss our next video. We are going to be diving into the world of stock buybacks. It's an essential way companies return money to stakeholders, and we're going to be talking about how they work and how do they impact you as an investor. Stay tuned to find out, and we'll see you in our next video.